If they let this to continue, silver might reach $100 in a New York minute after breaking through $60, $80, or $100. Who or what will they act upon? For the simple reason that it poses a threat to the world's currency, all global trading houses, and the bullion bank. Nothing will happen in a news vacuum when this is permitted to unfold. I've been stating this in my newsletter for the last 15 years, and it finally came to pass. Just look at the silver supply and demand imbalance. That's all. This has persisted for the past 5 years, you know. That being said, the 8 largest dealers have persisted in maintaining the current commodity prices, including silver, a commodity that is already the most shorted on the planet at this moment. The silver price was $50 in 2011, 1980, or whatever. I recall that it was 1980, and I was perhaps 30 or 32 years old. It was then that I realized how much money I had made. My best guess is that I purchased silver at 27 and sold it at 38. Afterwards, I repurchased it at 42, got my rear handed to me, and resold it for 12 or so. You remember your major blunders, and I want you to know that. I understand. Looking at $50 though, you know, $50 worth of silver in 1981 was a lot of money. You can still go to the movies for $4, $4.50, or whatever the going rate was in those days. The price of a 6-pack or 12-pack of beer was around $6. I understand. And when you consider the debasement of currencies and the massive creation of new money, the 12-pack becomes even more remarkable. In any case, the point is that, you know, considering debased currency and the passage of time, in my humble opinion, silver should currently be priced at least $250 per ounce in US dollars. Consider this. I own Keith Neumeier's Triple Digits t-shirt. I wear it constantly. And, you know, he's totally right. You know, he's been really vocal about this for a long time. And it's something that a lot of people, including yourself and other guests on the show, have been saying. Silver prices should be significantly higher, and $250 would be a good price. The problem is that the repercussions of allowing a short covering rally to happen are absolutely enormous. In fact, they may be twice as high as if the market were permitted to behave normally. Inflict death. Many commodities trading houses and the banking system would collapse under their weight. I'd rather not even consider it. Concerning the potential trigger, it may be the FOMC meeting next Wednesday, when they announce a half-point interest rate drop. Someone may stage a false flag in Ukraine, Israel could launch an attack on Iran, or the US could make a blunder in, Venezuela. The number of black swans is staggering. I can't even make out the water to accommodate them. It could be triggered by anything. The point is, though, that once they decide it's going to happen, it will be permitted. No, it will not be a market-based affair. Just as you mentioned, it will be something that comes along, and they let it rise, all right? As Ted Butler said, there will be a day of reckoning like no other when it happens, if they let it happen the way it should. Butter spreads unevenly across a mountain of bread. That concludes the line, all right? I thought you might be interested to know. The inability to put a price on the unpredictability of the effects of a sharp increase in the value of precious metals like silver and gold is a challenge that both Ted and I share. You know, the margin of call accounts is where the majority of the short and long positions in COMEX or stocks are stored. Since there is currently a Bryden high in the COMEX futures market, it would be wise to lengthen 100 contracts if you are short 50 contracts. I personally know someone who is short 100 contracts. However, those that are short must cover their margin calls. Their broker will not even answer the phone if things go wrong. They will simply attempt to purchase any contracts that these individuals are lacking, all right? The broking is ultimately responsible for this together with the customer. Thus, covering the position is impossible. The broking is supporting this individual's short position. Among the several broking houses and family businesses that make up R.J. O'Brien, 3 British banks, RBC, Canadian Bank of Montreal, PNB Paribas, and Deutsche Bank, are heavily short silver. All right, so that are Barclays, HSBC, and Standard Chartered. Additionally, Macquarie Futures, an Australian firm, is simply extremely short on silver. The Big Short is a great film, by the way. However, there is one unknown that I will bring up again now, Dan. The fact that almost all podcast listeners will be familiar with it. Making a film on something that complex required a lot of guts. One element that many people miss is that, as I recall it vividly, there was a person giving a speech towards the close of the film gushing about how fantastic Bear Stearns was and how he was going to be purchasing further stock. As the stock price plummeted from 25 to 30, 15, 13, and finally 13, the entire crowd watched on their iPads and iPhones and commented on the phenomenon. The widespread belief that it was connected to the credit default swaps, mortgage-backed securities, and collateralized debt obligations, CDOS, that caused the massive financial crisis from 2007 to 2009 was partially correct. After all, every single bank was eventually bailed out. However, the true cause, as Ted Butler had noted, was that Bear Stearns was the largest short in silver and gold during that period, and they were unable to meet what Butler estimated to be a $2 billion margin call, meaning they would need to find a way to cover it. In order to prevent Bear Stearns from going bankrupt and being forced to cover their short positions in gold and silver, which totaled 20,000 contracts, the Federal Reserve and the Treasury Department approached Jamie Dimon and pleaded with him to bail out the financial firm. Consequently, the value of precious metals like silver and gold would skyrocket. Consequently, they were unable to let that transpire. Thus, Jamie Dimon was given the short position, which he subsequently sold off a few years ago. Finally, they were able to get out of it because he brought the price of silver down to $9 and gold to, I don't know, whatever. It is really appreciated. That was the final straw that caused Bear Stearns to collapse. The reason, as Ted explained in his public domain article, is that they were unable to meet a margin call. Even if they're out, thousands of traders are holding short positions. Short squeezes occur when investors hurry to cover their positions or when their broking firm announces that they will simply take their shorts, their margin states that they must cover their positions, and everyone rushes into the market. Two things are still up in the air after that. What will happen to the commercial traders? There are probably 100 or so of them in the silver market, when the shorts try to cover and the price goes through the roof. This could happen if the financial system experiences a similar collapse to the one in 2009, which necessitates bailouts. The only difference is that it comes in a lot of different commodities instead of just silver, gold, platinum, and a number of others. So, what is the Federal Reserve's expected response? The CME Group's reaction? What do you think? Which way will the LBMA swing? Please, everyone, listen up. There is only one way out of this situation. If the 4 precious metals are to be closed off from trading by the CME Group and the LBMA, all short traders from 1 to 5,000 will be released from their positions, and the long traders will lose all of their profits. However, that is their sole option for rescuing the economy, since a short covering rally left to run its course to undetermined prices will once again collapse the financial system, just as it did in 2007 and 2009. You can put your money on the outcome if you want my opinion on this. This market, though, is where my strength lies. Of course you are. Every single one of you listening is. In fact, you ought to be there. I pray they aren't very strict with us when it goes off. The text was transcribed using turboscribe.ai. Remove this message by subscribing to Unlimited.